Good evening, members. Good evening, members. Before I start with this session, I just like to make an announcement. We have a GCC summit on December 12th and 13th. Please register for yourselves and please do communicate with your connected people so that they take advantage of that 2-day session. Okay. Thank you. Members, I welcome you on behalf of the Management Committee of the Bangalore branch of ICI for this study circle meeting on PGBP, Profit and Gains of Business. We have 2 sessions today, which is Profit and Gains of Business Charging on and Deduction Provisions under the Income Tax Act 2025, Disallowance and Audit Provisions, including presumptive provisions under the Income Tax Act 2025. May I request the Chairman, Bangalore branch, to please escort Zeel Gala, sorry. Zeel Gala. It's very much tongue twister, sir. Yeah, let's have a round of applause. Because it's a privilege for me to introduce today's speaker. The first one would be CA Zeel Gala. Zeel Gala is associate partner of Through Advisories. He is a qualified chartered accountant. He is a commerce graduate and a law graduate too. He has worked on tax practices with Big 4 consulting firms. He has also had a brief stint in the industry. He has more than 16 years of post-qualification experience in tax and regulatory areas, including corporate tax and international tax matters. He has advised a large number of Indian and multinational clients across sectors, including manufacturing, media and entertainment, IT and ITES, edutech, etc., on a variety of Indian tax matters as well as cross-border arrangements such as advisory matters relating to royalty, FTAs, permanent establishment, advising on onboard and inboard and outbound entry and exit and profit or cash registrations strategies for Indian and overseas jurisdictions, tax litigation supports. He has expertise in advising various clients on a wide range of transactions, including tax due diligences, internal corporate restructuring, mergers and demergers. With this brief introduction, I present before you Zeel Gala. I also request Bhandari sir to please escort CA Siddharth Bhandari. Please sir. And please offer him a flower bouquet. Apache sir. CA Bhandari sir is past chairman of the Bangalore branch. Let's have a round of applause please. Members, I would also like to introduce our today's second speaker on disallowance and audit provisions, including presumptive provisions under the new Income Tax Act 2025. CA Siddharth Bhandari is a fellow member of the Institute of Chartered Accountants of India with over 13 years of professional experience. He holds Bachelor in Commerce as well as the Law degree, certified as a forensic accounting and fraud detection combined with financial expertise with legal acumen. He had extensive training at Big 4. He had joined his present firm, MR Bhandari and Co. as a partner in 2017. Siddharth is also equipping him with specialized skills in investigative and compliance-driven engagements. He has also been a guest faculty at Christ University, Bangalore, as part of his passion for sharing knowledge and experience. His professional experience spans audit, advisory, and compliances, where he has consistently delivered solutions aligned with evolving traditional and corporate practices. Siddharth's contemporary style of working ensures that business benefits from updated, practical, and legal second approaches approaches to governance and financial management. With this brief introduction, I also present before you Siddharth Bhandari. So, Zeel sir, you can.
So thank you and good evening everyone. I hope I am audible till the end and am I audible? Okay. So thank you first of all the managing committee of Bangalore branch for giving this opportunity to me to present on this very critical topic of profits and gains from business or profession. And the sections I am dealing with is the charging and the deduction provisions. And of course my friend Siddharth is going to take the second session on some other provisions of PGBP. So if we just kind of go back and rewind the story, how it has unfolded in terms of the current law. The story so far has been that Finance Minister tabled the Income Tax Bill 2025 in Feb 2025 during the budget session of the year 2025. After that, a parliamentary select committee was formed to review the bill and invite various stakeholders' comments, responses, the views of Ministry of Finance, views of professionals like us. And the parliamentary select committee came up with a Herculean report of almost 4,500 pages in the month of July 2025. As a part of its effort and as a part of the outcome of the report, the effort which had gone is 36 sittings of this committee, a hearing totaling to more than almost 127 hours, 322 stakeholder representations across the nation, and of course views of Ministry of Finance explaining the rationale of various provisions or kind of explaining the reason behind change or no change, etc. And of course largely as we have all been hearing all along is that the thought process has been that there should not be any policy change as far as the new law goes. It's more in terms of ensuring that the framework in which basically the Income Tax Act 1961, which created a lot of complications in terms of readings, the spread out of sections, etc., that should be the focus area. And as a part of that, it came out with 566 recommendations. Post the Parliamentary Select Committee's recommendations, the original bill was withdrawn in August 2025 on 8th August. And thereafter, the Finance Minister introduced Income Tax number 2 Bill 2025 on 11th August, keeping in mind these simple objectives, which is streamlining the structure and language, ensuring the sections are integrated and concise, an attempt to ensure that there is a minimized litigation, ensuring that everything is practical, transparent, easy to learn and adapt, and there is an efficiency in the overall tax reforms. Probably a first stage towards the overall efficiency by first ensuring the law is made more simple, and then of course as things progress, efficiencies on the administrative and other aspects. Finally, the law was passed and the President gave its assent on 21st August 2025, and we have this Income Tax Act 2025, which you can see this green book here, which is kind of a law which will come into effect from the tax year 2026-27, 1st April 2026. And tax year here would mean definitely the previous year in the current context of the financial year, if that is more the general context. In terms of the provisions of profits and gains of business or profession, there were I would say that these 6 key areas which the new law has, or the new Income Tax Act has addressed. The first aspect is it has ensured that the flow of sections is made more logical, more coherent, so that, let's say, if there is a charging provision, then a deduction provision, then a disallowance provision in a particular logical flow, as against the current law where, let's say, there is a section 28 and then after section 40 where there are disallowances, again you would have, let's say, a 43A which deals with a foreign exchange deduction or foreign exchange related laws. So the idea has been that to ensure that there is a logical flow, a connected, coherent flow, so that any reader, any new professional who is practicing tax laws would be able to kind of make the sense out of it. Similarly, what it also did is that all the presumptive taxation related provisions were kind of compiled in or consolidated in one basket, let's say for residents and non-residents, and probably Siddharth will touch upon that. I don't want to dwell too much into it. The third aspect it did is to ensure that some of the aspects are provided by way of formulas, so that any particular reader is able to understand that finally as a mathematics, what is it that you are kind of coming to. For example, if there is a foreign exchange related adjustment for a realized foreign exchange liability or for which you have acquired assets from overseas, and if there is an adjustment to be done, then how do you kind of compute that realized foreign exchange? Or how do you compute an actual cost of an asset? So all of those have been kind of given through some formulas. Those explanations have been made into formulas. What has also happened is that all the provisos and explanations which would at times become very cumbersome to read and very complicated in terms of how it is being interpreted, those have also kind of been done away with to address any ambiguity. It has also ensured that all the redundant provisions, let's say for example section 32AC or 32AB, all of those have been kind of done away with, which are currently not relevant. So all those provisions essentially are kind of done away with. And of course there are certain aspects which are very specific to a particular industry, let's say an insurance or a coffee and business, coffee and rubber business, etc. All of these, again, the way the new law is ensured is that those relevant computation provisions pertaining to a particular business or a sector are kind of moved to a new schedule without complicating the main kind of provisions. So all in all, this effort has led to reduction of the PGBP sections from the current number, which are almost 65 sections, to almost 41 sections under the new Income Tax Act 2025. So lastly, if we look at this table, if we look at the chargeability provisions which are currently, let's say, as a part of section 28, 29, in the new law basically dealt under section 26, 27. The expenditure related provisions which are, let's say, currently in 30, 31 or 36 to 38 are dealt in 28 to 34. Depreciation is dealt in section 33 under the new law, and so on and so forth in terms of the alignment. So just to kind of set the context for my session and what to expect from my session, I have largely dealt with these 3 areas. One, what is the effect of the various views which have been expressed by the Ministry of Finance and the Parliamentary Select Committee report? What is the effect of that? Because that in some sense is going to be a very fundamental document in the way this new law is going to be interpreted for going forward many number of years. The second aspect which I plan to kind of deal with is the key areas in terms of these sections, basically in terms of what were the thoughts of the Ministry of Finance and what were the kind of recommendations of the Parliamentary Select Committee in terms of either accepting those thoughts or not accepting or negating those thoughts. Basically, it's a refresh of the recommendations of the Parliamentary Standing Committee report, I would say, taking into account the stakeholder suggestions. And the last part, maybe briefly, I would touch is, therefore, what should one expect going forward once we come closer to the implementation of the new Income Tax Act. So let's talk about the first aspect of the effect of the Ministry of Finance position and the Parliamentary Select Committee report. Now, I'm sure each one of us who has been practicing tax laws, income tax laws, would have come across these aspects wherein Ministry of Finance has basically clarified its position or given its views on some of the very vexed issues, let's say waiver of a loan in the case of IBC matters, or taxability in case of tax neutrality in case of a fast track demerger, and various others. Now the point is, to what extent can one rely on these Ministry of Finance views? So if I have to kind of give a simple context, it is like, for example, whether a Ministry of Finance basically would be, Ministry of Finance's views would be as good as a memorandum which comes as a part of finance bill, or it is more as a views of an executive body, because ultimately Ministry of Finance is an executive body and not a legislative body. Now, if we therefore look at a bit of a judicial context in this regard, in terms of what is the legal sanctity of the views expressed by the Parliamentary Select Committee. So, there are these very important landmark decisions in the case of, let's say, Kalpana Mehta and Union of India, wherein in some civil matters, basically, similar question of law had come before the Supreme Court, saying that to what extent can one rely on a parliamentary committee reports. And the Constitution bench in that case had clearly laid out these principles to say that this report should be considered as an external aid for statutory interpretation when some of the words are ambiguous. It will help you to evaluate the historical background of a law or the nature of a problem which was trying to be dealt by the report. And it has a persuasive value. So that's very important, because what it means is that what views are expressed by Ministry of Finance or what recommendations by itself doesn't mean that it has a binding effect. It is more like a context which will help you to read and interpret the law in the coming times, and it is more of a persuasive value in terms of how the law has evolved or developed. So essentially what it concluded is to say that the recommendation of Parliamentary Committee is preceded the enactment of a statute, and so it can be external aid, but it cannot be decisive, and the court is free to arrive at its different conclusions. So therefore, similarly, if you look at various other judicial decisions, even in the context of income tax laws, there are these decisions wherein references have been drawn to the earlier committees, let's say Offshore Committee in the context of GAR provisions, or a Vanshu Committee in respect of certain matters dealing with 44AD or Settlement Commission. But by and large, the principle therefore what we are looking at is that these committee reports are persuasive value. It is an external aid to interpret the law, but by itself doesn't become binding, or rather it does not become decisive, and the courts are free to interpret the way these laws have been drafted. This aspect is a thought which will help you to keep the entire, when you analyze the new law, read the new provisions, to keep the context in mind and not be driven away completely by the way a parliamentary select committee has given its recommendations or Ministry of Finance has given its views. With this, let's move to the main key provisions of the Income Tax Act. And first, let's talk about the most important charging section of the Income Tax Act 2025, which is Section 26, which is equivalent of the current Section 28 of the Income Tax Act 1961. So broadly, as a preamble to the Parliamentary Select Committee report, the Ministry of Finance very clearly laid out its view that the definition of income for the purpose of PGBP is inclusive, and it also clearly laid out the context to say that what it has done is that it has textually simplified the entire content of PGBP provisions and essentially retained the text as it is to the large extent possible, except one kind of section where, for example, Section 28 3A to 3E of the current Income Tax Act, which deals with export incentives, given that there have been certain disputes on the taxation of some of these incentives, there has been some rationalization of the language, and maybe we'll talk about that, but that's the only area where it has kind of tinkered with the language to ensure that there is a rationalized language to reduce litigation. And as a part of dealing with Section 26 provisions, there were, I would say, these are the four key aspects which the Ministry of Finance and the Select Committee basically dealt with. One is the impact of this language relating to the export incentive. The second point is regarding the waiver of loans pursuant to IBC resolution plans. Third is relating to the clawback of gains on sale of capital assets for which expenditure was already claimed in 3580. And the last is relating to the real estate business, so taxation of income from letting out of residential properties. And we'll take it one by one. Now, if you look at this first aspect, which is 26 2E of the Income Tax Act, and I have compared it with the current law, the green highlights, I'm not sure to what extent everyone can see, but the green parts, I would say, are somehow covered in the new language. For example, a sale of license under the import control order, 26 2E talks about profit on sale of import license. 3B talks about cash assistance against exports. Under any scheme, here the language is cash assistance against export receipt or receivable, without drawing any reference to any scheme or anything, it's open. The third, 3C talks about duty drawback under again a particular act. Here also it talks about duty drawback. And 3D and 3, if you see, talk about profit on transfer of the duty entitlement passbook scheme being duty remission, and same way for duty free replenishment certificate. Here there is a terminology for duty remission, but there is nothing to deal with the profit on transfer. But at the same time, the new provision talks about any other export incentive which apparently is missing in the current law, and which is probably the defect or the area which the Ministry of Finance felt was creating litigation. Now, if you look at a bit of a background on this aspect, if you see the current Section 28 is essentially deals with duty drawback or a duty remission and a cash assistance under 28 under particular set of laws or schemes of the government. Whereas the new section doesn't talk about or doesn't give reference to any particular law or scheme of the government. And therefore, a question I'm sure which would arise in the coming times is, if let's say there are duty credit scripts under a merchandise export scheme pursuant to the license issued by DGFT, and these MEIS scripts are basically export-linked rewards which are granted under FTP to compensate exporters for infrastructural efficiencies. And I would just briefly want to take a look at this language of this scheme, which says that the objective of this merchandise export from India scheme is to offset infrastructural efficiencies and associated costs. And it also says that these notified whatever exports will be rewarded under MEIS. So the current Income Tax Act, the judicial precedents which have come in these contexts is to say that the current 224/18, which talks about assistance in the form of subsidy, grant, cash incentive, duty drawback, waiver, concession, or whatever name called, the precedents have held that by whatever name called should not extend to something of this kind of an incentive, because you have to take the meaning of this from the earlier lines in terms of a subsidy, grant, or incentive. But here is a case where it's a reward for exporting to these exporters and to ensure that this reward is given for addressing the infrastructural efficiencies. And therefore the courts in this context have held that such MEIS scripts should be treated as capital receipts because it's a reward and not a cash assistance, and therefore it cannot be taxed as a PGBP. So if you look at these tribunal decisions, be in the context of Leshark of Mumbai Tribunal or Eastman or Mayur Union Courts, all of these decisions have subscribed to this position. Now, therefore, a point to ponder would be that whether the new Income Tax Act would continue to align with the current framework, or whether the terminology any other export incentive is wide enough to cover these kinds of rewards. Or basically one would say that okay, in the new context also, the preceding lines are cash assistance against export duty drawback or duty remission, and therefore you have to take the color of this term also from the earlier terms, and therefore it should not be taxed. Probably times will only tell whether this kind of an interpretation will be continued or not. But this is one area definitely to watch out for. Moving a bit further on this is again the another area which we talked about, which deals with the waiver of loan in the IBC cases. And the stakeholders, various stakeholders suggested that if there is a waiver of loan because a particular target company is under IBC, and because as a resolution applicant he would not pay these entire loans and these loans would be waived off, these waiver of loans should not be taxed in the hands of that IBC entity. And the logic or the rationale for that being that it is to ensure that this resolution goes through as a going concern and it doesn't create any financial stress. The Ministry of Finance also had its views to say that no, we can't exempt waiver of loans. We believe waiver of loans should continue to get taxed under 28(4) because we as a Ministry of Finance who has drafted Income Tax Act has already provided you incentive in section 79 by ensuring that IBC companies, if and when acquired, their losses are not lapsed. Their losses would be so sufficient that all of these waiver of loans would also be kind of get offset against those losses. So there is no question of any tax. The third aspect being that Ind AS also requires you to credit the difference between these gains in the profit and loss account. And the last aspect, it has relied again on various precedents saying that okay, all of these again help our case to say and our views to say that the waiver of loan under IBC should be taxed under 28(4) irrespective of whether it is for capital purpose or working capital loan, whatever. So in terms of the Parliamentary Select Committee, it noted all the suggestions, it considered all the comments, and retained the section without saying that okay we agree or we disagree or whatever. Basically it retained the section as it is without any exclusions. And therefore again this area is going to be left open for all of us and the judiciaries to be fought out in the courts as to decide whether the waiver of loans would continue to be taxed under 28(4), which is under the current law the 26(2)(f) of the Income Tax Act 2025, or if we go by the Ministry of Finance's views and the perspective it has given, it will now actually be taxed, and there is no argument at all irrespective of whether those loans are for capital purposes, working capital loan or any other aspect. So that's the another area of where there is definitely something which we have to kind of look out for. The third area is a slightly interesting and a slightly so here what has happened is, if you look at the current section 28(7), it is very clear to say that if let's say there is some asset, capital asset you bought, and if let's say you claim a deduction of that entire capital asset expenditure under section 35 AD, and if you subsequently transfer that capital asset, you will have to offer that same whatever monies you have earned as a part of that as under PGBP, and you can't offer it under capital gains because you had already claimed 100% deduction of that under 35 AD. The new Income Tax Act, while the original bill was framed, basically the similar provision was inserted, but this language that the whole of expenditure on it has been allowed, any sum which is received or receivable in kind, when the whole of the expenditure on it has been allowed as a deduction under 35 AD was missing. And therefore the stakeholders came back and said no, there is a mess in this law, because if let's say I have claimed a 35 AD in financial year 24-25, and in 26-27 when I sell that asset, the law doesn't talk about taxing it, because it only talks about any deduction which is claimed under 46. Now I have claimed the deduction under 35 AD which is under the previous law, and therefore there is a need for a parity. What interestingly the stakeholders also highlighted is that the provision of repeals, which ideally should have addressed these lacuna to ensure that there is a consistency, that repeals related section, which is section 536(2)(h), also doesn't talk about the basically this particular provision, and therefore definitely this is a potential recipe for a controversy to emerge, that something which I am claiming as an expenditure in under 35 AD in early years can get kind of part of controversy, whether it should be a part of PGBP or capital gains. And therefore Ministry of Finance also kind of agreed with this lacuna, and it kind of select committee also kind of accepted and made this change. Now therefore a question for a natural all of the professionals would be that, okay, if you are talking about 35 AD, what about other provisions like let's say a 41, wherein if let's say there is a normal trading expenditure I claimed in earlier years and there is a write back of that trading liability, and there should be a similar thing for 41, there should be a similar thing for let's say a bad debt recovery or any other stuff, and to which the only point I would say is that there is a clear answer to it, and I think in all wisdom the law has ensured that the repeal provisions deal with all other such situations to ensure that that consistency is maintained, and this 35 AD was the only exception probably which was not appropriately dealt with. Moving further, so there is this one aspect which keeps on coming, and real estate developers and the stakeholders in support of that basically keep on coming that, okay, as a real estate developer, if let's say there is any residential properties which I am letting out, ideally that should not be a income from house property, which the current explanation 3 to section 28 has introduced, and the new law should give some relief or some respite to these real estate developers by taxing such incomes as income from profits and PGBP as against IFHP. The Ministry of Finance and Parliamentary Committee straight away rejected these suggestions, saying that this is a policy level change, and as a concept it said that we want to keep all the things aligned with the current law, and therefore these changes were not accepted. And the new law also ensures that any residential property, house property income should be taxed under the head IFHP, even though it might be owned by a real estate developer. Now, talking about these sections which deal with rent, rates, repairs, which is the current section 3031, largely the framework remains the same, except that there were two areas where there was a bit of deviation which got rectified. The first area was regarding the use of the words wholly and exclusively. So the way the new section was worded is to say that deduction in respect of premises, machinery, plant or furniture wholly and exclusively used for the purpose of business or profession should be deductible. To which there were again various suggestions from stakeholders to say that this is not a required word, it's an unnecessary inclusion. It doesn't align with the current law, because the current law also ensures that if, let's say, there is a furniture which is partly used for business, partly used for personal, then appropriate disallowance to the extent of it is used for personal purposes is kind of done, and which then the ministry as well as the select committee also agreed and ensured that because there is a provision under section 28(2) which helps you to disallow if there is any non-business use of a particular plant, machinery, furniture, then to the extent of that disallowance is kind of taken care of. So therefore these words become unnecessary and additional. To that extent it is now aligned with the current law. Similarly, the concept of current repairs, which is there under the current law, to say that if there is any amount paid on account of the current repairs which is not in the nature of capital expenditure, that should continue to be allowed. That position was kind of somewhere not correctly inserted in the current law, in the new law, which has also been rectified, and therefore any expenditure considered as current repairs which is not in the nature of capital expenditure will continue to be a deductible expenditure. And therefore in that sense, when we say current repairs, it would mean any expenditure incurred to preserve and maintain the assets which is not resulting in enhancement of the asset or creation of a new asset or enhancement of the useful life of the asset would be kind of covered as a part of the current repairs. Moving further into the employee welfare related provisions. So if we look at the current framework, basically there is a section 36 which deals with the employee benefit welfare deductions, and also there is a section 48 which kind of essentially deals with some of the disallowances in the context of contributions to provident fund, gratuity, etc. As a part of Income Tax Act 2025, all of these sections pertaining to employee welfare has been consolidated into one provision, which is section 29 of the Income Tax Act 2025. And there were two aspects which essentially came before the discussion. The first was the interplay between section 29(1) clause C and clause D, and the other was related to the reasonable time. Let's talk about the first one. Basically, if you look at this provision, the first clause C talks about any sum paid by way of a contribution towards a gratuity fund created by the SEC for the exclusive benefit of employees under an irrevocable trust is a deductible expenditure. And similarly, there is a clause D which says that irrespective of anything contained in subsection 2, any provision made for the purpose of making contribution towards accrued gratuity fund or for the purpose of payment of any gratuity that has become payable during the tax year, even that is deductible. And the stakeholders basically questioned these two clauses and were of the suggestion that, okay, why do we need these two clauses? Probably only one of the clauses is enough. Probably a clause C is good enough to take care of the deduction of these approved gratuity funds. and clause D seems to be not necessary, and it is unnecessarily creating some ambiguity. The Ministry of Finance and the Select Committee basically heard these stakeholder suggestions, but it clearly stuck to its position to say that both these clauses are equally important, and the reason provided by them is that if we look at the way these both clauses are worded, the one clause talks about the amount of deduction which will be available, and the other talks about the non-deductibility where a provision is created without the actual payment. So therefore, because it is dealing with both the aspects, amount of deduction as well as the actual payment, both the clauses are important, and there is no ambiguity at all. It aligns with the current law, and that's what has been accepted as well. The other important aspect, and I'm sure most of these professionals, when we do tax audits or we look at various companies who have to contribute to these statutory funds, let's say a provident fund or any other funds which are for the benefits of employees, and if there is a miss on the part of the employer to deposit the contributions of the employee pertaining to the employee's portion to the fund within the relevant due date as per the relevant statutory law, then that is kind of disallowed. And there were again stakeholder suggestions on this particular aspect to say that this is a very harsh provision. There can be misses, and give some leeway for that in terms of some reasonable time. If let's say there is a 90-day within which you are paying it, or if let's say there is a reasonable cause in terms of a government website not functioning, or there being some mishap which is not within the control of the employer, there should be some leeway, and that was what the stakeholders were suggesting. The Ministry of Finance and Committee again said that no, this is a policy, this will become a policy decision, and therefore whatever suggestions the stakeholders are making can't be accepted, because this is already settled by a Supreme Court decision in the case of checkmate. Now, important thing here to kind of probably note is that recently there is a Delhi High Court, in Delhi High Court there is a writ petition which has been filed to say that checkmate cannot be applied very blindly, especially in cases where there is a reasonable cause in terms of, let's say, a website of the government not functioning or something which is beyond the control of the employer. And for that, definitely if there is a minor delay, that should be taken kind of note for, and should not be harsh on the part of the on the employer. And probably one will have to wait and watch in terms of how this writ petition is kind of moving. It has been admitted by the Delhi High Court. Delhi High Court has noted that they are willing to hear this kind of a petition, although there is a checkmate decision, and one will have to wait and watch in terms of how this pans out. But definitely then it kind of to that extent may have some bearing and some impact on the how we read the new Income Tax Act as well. Some minor aspects in terms of the deduction for bad debt, and if we look at this movement, basically there is the first column is talking about the current Income Tax Act 1961, the middle one is talking about the income tax bill when it was placed for stakeholder comments, and the third one is talking about the latest Income Tax Act. And probably there was a typo error, I would say, in terms of any basically bad debt which is becoming irrevocable, which was mentioned as irrevocable, and probably that has got rectified. If we talk about certain other deductions which are dealt in the section 32 of the Income Tax Act 2025, again largely it is aligned with all the section 36 deductions, which covers a variety of deductions, and there was a deviation in terms of the mark-to-market losses, wherein there was some deviation that it was not getting sorted, which has also been sorted, and we will talk about it. So basically, if you look at the current language, any mark-to-market losses which are in accordance with ICDS, only that are deductible, which was a miss when it was placed before the income tax bill. but now the Income Tax Act has rectified that, and even that aligns with the current law to say that mark-to-market losses only as per ICDS will be allowed. Talking about depreciation, which is a very important provision, and if you look at the current section 32, it had 6 subsections, 8 provisos and 6 explanations. So what new Income Tax Act 2025 section 33 has done is, it has converted all these provisos and explanations into various subsections and a part of section 33. All the redundant provisions which were not required have been kind of deleted. And as a part of discussion around the depreciation, I would say there are four aspects which we will deal with. And let's talk about it one by one. And if you look at this current language of section 33, or if you look at the current of section 32, and the way we have kind of read it is that in the assessment of an SSC, full effect cannot be given to any allowance under subsection 1. So the point I am trying to make is that so far we have already always understood depreciation to be an allowance and not a deduction of expenditure. What we call it is a depreciation allowance. Now if you look at the language of section 33 of Income Tax Act 2025, it says a deduction in respect of depreciation shall be allowed. And if you look at clause 11, where the profits and gains chargeable for the tax is before allowing the deduction. And the point to consider is, does this change of allowance versus deduction have any bearing in terms of applicability of any other provisions of the income tax law? Or this is semantics and probably it doesn't need to be kind of too much thought about. Now if you look at some of the variations, if you look at allowance for depreciation, the section 116 and 117 of the new Income Tax Act, which deals with treatment of losses in case of amalgamation or carry forward of set off of the losses, they still refer to the terminology of depreciation as allowance and not deduction. But if you look at 33(7), it again says that the provision of this section shall apply even when the SEC has not claimed deduction for depreciation. So, therefore the point is, if let's say currently the way we have been interpreting the depreciation provision to say that it is an allowance, and therefore have been taking a position that, let's say for example, if we talk about this Karnataka High Court decision of Tally Solutions, which dealt with the issue that if let's say there was some capital expenditure in which depreciation was claimed, and the issue was that okay, because TDS was not deducted, it becomes amount payable and therefore the expenditure should, or the depreciation should not be a deductible claim. And to which the court held that deduction under 32 is not in respect of amount paid or payable which is subject to TDS, but it is a statutory deduction on an asset which is otherwise eligible for deduction of depreciation. And it also said that section 40A I and 40A IA, which deal with disallowance of expenditures of revenue nature, that do not apply to depreciation because it is not in the nature of expenditure but an allowance. And therefore the point is whether the language of the new section 33, which talks of deduction of depreciation at various places, although there are some other provisions which again talk about allowance, do we still apply the same principles to say that okay, it still remains an allowance and therefore the provisions of section 40 AI and various other provisions still need to be looked at as if it is an allowance, or because it is a deduction now, all these provisions start get triggering and therefore one will have to kind of see to it that the depreciation is also disallowed if there is TDS, adequate TDS is not paid on this one. Of course again, there is not much literature and time I am sure will tell in terms of how this develops, but definitely there has been no discussion on this aspect in the current report or any stakeholder suggestions. The other aspect which all the stakeholders were pushing was the aspect of depreciation on goodwill, which has been a very hot topic and very debatable topic, wherein there have been a lot of judicial precedents. And the thought process which stakeholders were trying to impress upon was that, okay, as long as, if let's say as a purchaser, I am paying the seller towards acquisition of a business, and if let's say the seller or the transferor is offering the entire consideration to tax, why is it that income tax is looking at depreciation on goodwill in such a narrow sense, and if the transferor is paying that tax and offering it as a taxable income, why not give the benefit of depreciation on goodwill to the purchaser? Ministry of Finance, once again, basically in terms of their views, highlighted that intangible assets, the goodwill has been specifically excluded from 2021. Their point of view is that goodwill can also appreciate. So why should there be a depreciation at all, something similar to a land? And therefore, this entire concept or thought process about depreciation itself is not acceptable. And their most important concern was that, okay, if we start allowing this, basically all the profit-making companies will start utilizing this and this will encourage a tax avoidance or a tax arbitrage. And therefore, basically going with that original theme and philosophy of no policy change, the select committee basically retained the current language, and therefore in terms of the impact, I would say that the impact is same, that even if you acquire goodwill, even if there is a price paid to that post 2021, there is no depreciation of goodwill and there is no change in position. The stakeholders also kind of try to give suggestion around the definition of the term sold, which is under Income Tax Act 2025. And if we look at this definition, it says that sold includes a transfer by way of an exchange or a compulsory acquisition under any law for the timing in force, but does not include. So basically there is an exclusion to say that any transfer in a scheme of amalgamation of any asset by the amalgamating company to amalgamated company, where amalgamated company is an Indian company or a banking company. Basically, if there is an amalgamation of companies, then this definition of sold excludes those situations. And the stakeholders kind of gave a suggestion that, okay, while this is dealing with amalgamation of companies, it is not dealing with the situation of amalgamation of cooperative banks. And therefore, if that exclusion is not provided, there is still a kind of lacuna to say that the sold would include these situations. And therefore, this was the suggestion to say that, okay, align all the amalgamation, including a cooperative bank amalgamation, in this definition. Again, Ministry of Finance and Select Committee said nothing doing. We go ahead with the select whatever is the current policy, and we are not extending any such benefit because it will lead to a policy change. And one of the crucial reasons which it gave was that amalgamation of cooperative banks is not monitored by the courts, which is unlike of amalgamation of companies wherein NCLT or a court is monitoring the process. And that probably was the discomfort which it kind of indicated. So if we look at some of the other areas where the Income Tax Act 2025 also ensures that it is aligned with the current Income Tax Act 1961, is if you look at the first bullet, basically if the asset was used for less than 182 days, the depreciation is restricted to the 50% of the overall rate. And this was missing in the income tax bill, which has been rectified. Depreciation on intangible assets was available or is available only in respect of assets which are acquired post April 1998. And the new Income Tax Act basically missed out giving a reference of this date, which led to interpretations that, okay, anytime if you would have acquired the asset, even prior to 1998, you will be entitled to depreciation, which again got rectified in the Income Tax Act 2025 to align with the current law. The aspect of additional depreciation being given if it spills over to the succeeding year of that 10% if in the preceding year it is used for less than 180 days is also kind of taken care of, which was not there in the bill. Some of the other stakeholder comments or suggestions which were put forth in the context of depreciation were that there should be a higher rate of depreciation for EVs, EV batteries, energy. The small value assets like which are less than 25,000 should be given 100% depreciation, and the depreciation rates should align with companies that nothing were accepted in light of the policy changes, and nothing changes on that account as well.
Now, what is the present status for depreciation period? 50%?
It's aligned, so nothing changes, everything remains as it is as per the current Income Tax Act 1960. Now, if we talk about the general deduction, basically which is the current section 37 of the Income Tax Act, the two aspects which were a part of the committee report and the stakeholder suggestions is, the first aspect was the aspect of the prior period expenses, where the stakeholders suggested that prior period expenses has been an issue always in terms of whether and when it is allowable, and it is leading to a perpetual state of confusion and litigation. So if there is a suitable provision to say that okay, prior period expenses should be allowed in the year as long as they have not been claimed earlier, and there should be some mechanism to limit the percentage of expenses so that there is no unnecessary litigation or administrative hassle. All of that was kind of not accepted by the ministry, and basically said that it is a policy change, it will lead to a policy change, and we therefore don't want to kind of create any unnecessary misalignment, and therefore the prior period expense issue also goes back to the current situation wherein we will analyze each of those expenses and claim a deduction in the year into which it pertains, saying that is expenditure of that particular year. The other aspect which was pushed by the stakeholders was the deduction of CSR expenditure, saying that CSR expenses are connected to social and charitable causes, and therefore the stakeholders insisted that these expenses should be allowed as a deduction, to which Ministry of Finance said that again this is a policy level change. CSR is a below the line item of expense, and any further deduction of CSR would essentially mean that indirectly government is funding that subsidy, which defeats the purpose to some extent, and therefore the position remains aligned with the current law to say that CSR expenses are not deductible and no deduction for that will be allowed. Some of the aspects again which were misaligned under the income tax bill. So if you look at the current section 41, which deals with let's say taxability of any expenditure which was claimed in earlier years, and if let's say there is a write back of that expenditure in a subsequent year, then the law says that if there is any allowance or deduction made in for any year in respect of loss, expenditure or trading liability, that will be taxed. And the bill, when it was placed in the bill form, it only referred to, instead of any year, it referred to the term as any earlier tax year, and therefore the concern was this could lead to an anomaly wherein if let's say within the same year, if I take a deduction on let's say 1st April, and if let's say by 31st March I know that okay, this expenditure is not going to happen and there is a write back, someone may take a view that no, this is not earlier tax year, it is the same tax year, and therefore this language was aligned to ensure that it covers any tax year, and that's the anomaly it is kind of solving. Similarly, if we look at the current section 41(2), which deals with the taxability of or the of the assets which are part of power undertaking, and where there is a balancing charge that if that asset is sold, then basically to that extent of depreciation, basically will be taxed as the profits and gains from business or profession to the extent you claim the depreciation for that. That was not aligned in the Income Tax Act 2020 in the bill, and which has been now aligned as a part of the Income Tax Act 2022. Some aspects in terms of, again, if we look at the current definition of actual cost, which is as a part of section 43(1), and one of the explanation in 43(1) talks about that where a portion of the cost of an asset acquired by the SSE has been met directly or indirectly by the central government, then to that extent, basically that amount which is met by the central government has to be reduced from the cost of the asset. When the bill was placed, or the language was the subsidy, grant or reimbursement, or whatever name called, if any, relatable to acquisition of asset received. So the words directly or indirectly were not mentioned, and therefore to that extent there was an anomaly as to whether something which is not received directly in some indirect form, whether that would be covered or not, and which has been again in the new law kind of ensured that it aligns to say that any subsidy received directly or indirectly. These are all nominal changes on the section 41. This is the section which I was talking about in terms of the formula, wherein basically whatever capitalization of foreign exchange fluctuation has to be done, which is the current section 43A, which says that if there is any realized foreign exchange gain or a loss, that has to be either added or reduced from the actual cost of the asset, if that asset is a foreign asset purchased from the foreign whatever monies, to which there has been a specific basically formula which has been put in place, so that there is a simplification of the language. On the amortization, which is the current section 35B, there have been a couple of aspects which were a part of the stakeholder comments and the select committee. One of the aspects is that the current section 35B, which deals with the amortization of preliminary expenses. If we look at the current construct, there is a 35B1 which kind of deals with the amortization of preliminary expenses, and there is also 35B2 which lists down a particular types of expenditure which will be be covered as a part of section 35B amortization over a period of 5 years. In the Income Tax Bill 2025, the way it got worded was that where the SSE is a company, only these legal charges for drafting and printing of MOA and AOA of the company would be amortized. And it read as if only these specific expenses, which is part of current 35D2, will be allowed as amortization, but the general expenses which are covered under 35D1 would not be allowed, which again the Income Tax Act has ensured that that parity remains, and it has aligned with the current language of section 35D. The other suggestions from the stakeholders was that given that we have these India standards and it deals with all these kinds of expenses, why not align the law with the NDS? Because that's the ultimate objective, right? That to simplify and align everything with the NDS standards. To which there was no agreement from the Ministry of Finance, because it believed that that is a deviation from the policy, and in a way, if there is a disparity between the provisions of law and the accounting standards, the current principle, which has been age-old principle to say that the provisions of law will prevail, is what it believes, and therefore it doesn't believe that whatever is the accounting should be followed even for tax purposes. There were suggestions to include cost accountants to certify these expenses, which was not accepted. And also there was a suggestion to say that if there are listing of debentures or shares by business trusts, something like a REIT, let's say, even those should be allowed, which are not currently allowed under the law as a part of preliminary expense. But again, that was not accepted because it was considered as a policy change. I'm not dealing with this ICSA, I think it's a change. Now, talking about the scientific research related aspect, basically the first aspect wherein the scientific research bit, if you look at the current law, the 35(2)AA talks about where SSC pays any sum to a national laboratory or a university or a IIT or a specified person, then there is a deduction for this expenditure, and the requirement is that the prescribed authority has to seek a government approval before you get this expenditure, research expenditure. Come income tax bill 2025, in the bill, the way it was worded was the section 45(3), which deals with scientific research. It laid down all these provisions which are, let's say, equivalent to the current section 35, and at the end it says that with a specific direction that the said sum shall be used for scientific research undertaken under a program approved in this behalf by the prescribed authority. And therefore the interpretation of this seemed to be that, okay, whatever earlier let's say clauses wherein the approvals of prescribed authority was not required, even those are kind of coming within the purview of approval, and unless an approval is sought, these research expenditures will not be available. This was noted, this deviation was noted and accepted by the parliamentary select committee, and it kind of said that while the language remains the same, the intent of this prescribed authority approval is only vis-a-vis 45(3)(c), which talks about national laboratory, university or IIT, and it doesn't kind of apply to clause 1, clause A and B. But if we look at the placement of this language, and this is the reproduction of 45(3), if we look at this placement of with a specific direction, it still is not placed very appropriately, I would say, because it is coming in the outer column, whereas ideally it should have come in the inner column of below 45(3)(c). But going by what the select committee has said, it appears that it should only apply to C, clause C, and not A or B. On the scientific research aspect, again there were representations that the cost accountants, etc. should be allowed to certify, which was not accepted. And there were also suggestions and stakeholder inputs to say that because we want to revive Make in India, why not again give the weighted deduction for all the R&D facilities, which again was not accepted. One other anomaly which was resolved was that if we look at the current in-house R&D facility related expenditure, which is 35(2)(a), wherein if let's say there is an in-house R&D facility, there was a weighted deduction earlier. Now of course there is no weighted deduction, but there is a deduction of any scientific R&D by in-house R&D facility. The way it read in the income tax bill was that this in-house R&D facility expenditure should be allowed as a part of subsection 1, which is, let's say, akin or similar to the current section 35(1), which deals with normal non-in-house R&D facility. I mean a normal routine R&D expenditure which is not necessarily as a part of the in-house R&D facility. And therefore the way it was reading is that only if, let's say, there are two sets of expenditures, one wherein there is the expenditure in in-house R&D facility, and if, let's say, there is another expenditure which is not in in-house R&D facility but outside of in-house R&D facility as a part of normal R&D, that would not be covered. It is only the in-house R&D facility which will be covered. Whereas the way the current intent of the law is that both are separate independent sections. That was not how it was reading, and that anomaly also has been addressed to say that the 45(1) and 45(2), which deals with in-house R&D, both are independent sections, and if there is any in-house R&D expenditure, that should be allowable separately, and if there is any normal R&D, that should also be allowed separately as a part of 45. On the aspects of section 3580, there were again some apprehensions which were raised by the stakeholders to say that whether the current circulars which are issued in the context of Income Tax Act, whether they will continue to apply, which define the term new infrastructure facility, etc. To which it was clarified that the repeals section, which is section 536(2)(j), already provides that any notification instruction issued under the repealed act will continue to be enforced, and therefore in a way these circulars will be inherited and all of this will continue to apply. There was a recommendation that HAM projects should also be covered under 3580, and this was considered to be a policy change, and all of that was not accepted. And again the cost account aspect was brought out, which was rejected. Some of the minor aspects in terms of reference in 3580 to SIC industrial companies, and there was a suggestion that given that SIC Industrial Companies Act has been deleted in 2000 or repealed in 2003, whether do we need to retain this language or not, and it continues to be retained. Again, these minor changes which were kind of not there in the earlier law considered. So all in all, if I have to kind of put it in summary and what to look out for is, in August 2025 there is a Income Tax Act 2025 which was enacted, and what one will have to look out for is how are the new rules, whether the current rules, how they are kind of ensure that they are transitioned, the ICDS provisions, how are they transitioned, what are the new forms which will be notified under the new law. One will also have to wait and watch in terms of the coming February budget. Do we expect any significant changes, or we don't expect any budget at all? Because if there is a 2026 date wherein this new law is going to get triggered, probably one would expect that there should not be any major changes. But again, we don't know. I mean, there could be surprises. And of course, the last part is how does when therefore ensure that all these new sections in terms of the systems, the references to the new sections, the challans, compliance, and all those transitionary aspects taken care of. And how do we keep on interpreting the new law with keeping in mind this persuasive value of the select committee report and the current jurisprudence which has evolved over the years. So all in all, I would say that largely the profits and gains from business or profession dealing with the charging and deduction sections, largely in fact everything except that export incentive has remained the same. There is no change, it remains consistent with the current law, and one will have to wait and watch in terms of how do we transition to this new law and how do we continue to apply the current jurisprudence to the new Income Tax Act 2025. I would like to end my presentation, and I look forward to any questions from the crowd if there is anything which I can address. Okay, thank you so much.
Very good evening to everyone present here. I would like to thank the Managing Committee of Bangalore branch of SIRC of ICAT for giving me this opportunity to be able to present the topic Disallowances and Presumptuous Taxation and Audit Provisions under the new Income Tax Act of 2025. My fellow speaker Zeel had already mentioned and covered a lot of aspects about how the Act had come into play and what was the timelines and what graph it has seen. So I'm not going to repeat that as well, and we're going to get directly into the topics which are here, which is about what kinds of disallowances are there under the new Act, what kind of changes are there if any, and how are we going to get impacted with these new provisions coming into play. The overall outlook of this entire topics which I am covering, I have noticed that the provisions under the new act are nothing but the same old wine in a new bottle. All the provisions and sections and the wordings are also very, very similar. The conditions and the provisos are also very similar to the existing 1961 Act. But the only aspect which we need to do now is we need to unlearn the sections and codes and provisos which we already learned, maybe for over a decade, 2 decades, 4 decades, 5 decades, I'm sure we all have. We need to unlearn ourselves and learn the new provisions and new sections, and also an opportunity for us to revise what we've been practicing and we've been we've been practicing and we've been implementing and understanding the statute as point of direct tax. So I would like to bring in overview of what all topics we'll be covering now in the next few minutes about what sections we have under the new act and what was the comparable old section under the old act. We have disallowances broadly classified under 3 sections, which is section 35, and it is in line with the provisions of section 40, which majorly deals with our TDS provisions and disallowances for mostly TDS provisions. And secondly, section 36 talks about payments which are not deductible and majorly are in line and sync with our section 40A of the Income Tax Act of 1961. Thirdly, we have our deductions allowed only on payment basis on actual payments, which is in line with section 43B. Section 37 talks about this over here. So these 3 sections, as the main intent of the law is to streamline the entire provisions, to bring in a lot of synchronization of the law and requirements. Disallowances have been fairly close to each other, but now they are coming in one after another, so it becomes easy for us to understand. A lot of other aspects are also there, but these are the broad major disallowances which are there, because we always have a few disallowances and restricted deductions also in other few sections, but we are going to deal with the major disallowances heads over here. Next, we'll be looking at presumptive based taxation, which has been a big game changer for the last over a decade nearly, and a lot of changes have been seen in the presumptive based taxations as well in the last 5 to 8 years, as far as I recollect as well. So these sections of 44AD, 44ADA, 44AE, which deals with presumptive based taxations in cases of individuals, HUFs and firms other than LLPs, these are broadly classified and covered under section 58 entirely. We also have a lot of sections covered under section 61, which deals with presumptive based taxation of non-residents and covers section 44B to BB, BBA, BB, BBB, BBC and BBD as well. These are mostly related to non-residents and covered under section 61 of the new act. And we would also be talking about applicability of Income Tax Act, which again fairly remains the same, what was there under the previous act and what we've been following under the assessment year 24, 25 and 25, 26 as well. Minor changes in 25, 26. But majorly we will be refreshing and basically recapping all our provisions, what we've been practicing for so many years, and also make sure that we are aligning our provisions with the new provisions of the new act. So section 35 majorly deals with amounts that are not deductible under certain circumstances. These are basically talking about deductions are not allowed and restricted in terms of taxes which we have paid, be it direct taxes, be it tax paid by an employer, and in terms of perquisites, taxes paid by any other country under which we are taking eligible relief under section 159 or 116 in line with 1991 and 91A of the previous act. So it is similar to what we already have under section 40. Nothing new over here again. Only thing is the section number has changed and the wordings are also fairly very similar in this section. Section 35 talks about irrespective of any other provisions under the chapter 4D, which talks about PGBP, broadly known as profit and gains from business and profession, following that it should not be allowed as a deductible expense. Sorry, I think this is not working. No, it's working. Yeah, clauses. And these also include any kind of taxes, include surcharges and cesses, whichever name has been called. Under section 35B clause 1, it is in line with section 40A IA, which talks about disallowances of expenses on which TDS has not been deducted under the various heads of chapter 17B is now 19B. So this talks about our deductions which have not happened during the year or deducted but not being paid within the year, in line with section 40A IA, which we are very broadly being working on and majorly concentrating during our audits. This disallowance will continue under section 35B, and whatever is there in terms of TDS if deducted in a subsequent year which is not deducted in a year which is tax year, say assessment tax year 25-26, which will be in effect from 1st of April 2026. So over there, all of these, if paid under the financial year or previous year or tax year which we will be using under 27-28, it will be allowed in the year in which the TDS has been remitted to the government, or also if there is deemed compliance by the payee or the deductee has filed the tax returns, included this income, paid the taxes and furnished a certificate which is famous under the form 26A under the present regime. So that still continues, there is nothing new over here. TDS under non-residents and international payments done to any amount in nature of interest, royalty, fees or technical services or any other sum payable outside India or to a person who is a non-resident or a foreign company, the 100% TDS over here or the tax amount, expense amount will get disallowed over here. So the entire expense which is there in the previous regime of 1961 continues over here, and it will be allowed in the year in which TDS has been paid, if any. If not, it will be permanently disallowed. Under the provisos are similar as mentioned in the previous TDS on resident payments as well. Section 35B clause 3 talks about employee benefits, which is basically any payments done to any kind of provident fund, gratuity fund, any other employees fund. It will not be allowed unless and until the necessary provisions are deducted in terms of TDS, where the amount is taxable under the head salaries. So any kind of payments which are liable for deduction under the head salaries, where deductions have been made to people who are receiving amounts from provident funds or recognized funds. TDS provisions, if not done, it will be disallowed. It is in line with section 40A(4) of the previous regime. Section 35C talks about salary payments to non-residents. In case if there is any salary paid to a person outside India or a non-resident, it will not be allowed unless and until TDS has been remitted. It is in line with section 40A(3) of the previous regime. Section 35D again covers payments in line with 40A(2)(b) of the previous regime, which talks about payments and royalty fees or license fees, service fees, privilege fees, etc. Paid exclusively or directly, indirectly from a state government undertaken by the state government. So these will majorly be dealing with the government entities and government organizations. So TDS over here, expense over here will not be disallowed in case any kind of expenses are being paid here. And section 35E talks about expenditure by partnership firms. These are broadly being used in the recent times, as there have been a lot of changes in the provisions, be it the provisions of TDS under section 194T, which came recently, and a lot of allowances, disallowances which we've been seeing. A lot of aspects I realized through my reading also of the Act is that we have been missing out on a lot of these finer prints and finer details in a lot of our clients and works, especially when we are looking at organizations in terms of partnership firms, which have been predominantly increasing as well. Coming to this aspect of disallowances over here is the previous regime under section 40B1, we were talking about any kind of salary, bonus, commission, remuneration by whatever name called, paid to a non-working partner is always disallowable. This aspect, unless and until this has been backed by the partnership deed, a non-working partner, even in the old regime and in the new regime, is not allowed to get remuneration. I have seen a few cases where we've handled a few other litigation works and all, where a non-working partner has been receiving remuneration and we have not fallen back to partnership deeds which have been maybe coming in from X number of years. So looking at these aspects again is a aspect to ponder upon to make sure that we are not missing out on the documentation when it comes to partnership firms and partnership deeds. The second aspect is remuneration is allowable only to a working partner and interest to be paid to any partner. Under the previous regime it was under 40B2 and 3 is disallowed, now it is under 35E2. So this section talks about if it is not authorized by the partnership deed applicable for the period, then remuneration or interest cannot be paid. There cannot be any changes done unless and until that is backed by a partnership deed which has been effective for the period in which we are doing the audit or filing the tax returns as well. Audit is not the only criteria. These provisions are applicable only also in the cases where there are non-audit business cases, especially with the threshold increase under section 63 now and earlier 44AB, where lots of non-corporate entities threshold has increased from 1 CR to 5 CR 2 years back and now 10 CR. So this aspect should not be looked only in audit point of view, but this has to be looked into any tax return point of view for a business case or a professional case as well. And anything which has been authorized under partnership deed but pertains to a prior period. Example, we had a partnership deed maybe made in the year 2005. In the year 2010 there was an amendment where the provisions under interest payable to partners was reduced from 12% to say maybe 10%. You cannot come back and say another year that now earlier I used to pay at 12%, it was there in the mother deed. My amendment I will ignore and I will look into it and take it at 12% today because it might be favorable in any of the cases. We need to make sure that we inform our assessees and clients as well to take care of these documentation, which is an important aspect. And the day isn't too far is what I see, that the department might start pursuing these documents again and start looking back at partnership deeds, and in terms of any kind of scrutiny assessments or any kind of search and seizure cases, this would be a challenging aspect which could have and might have been ignored in the past few years. So next point is section 35E. Clause 3 talks about our remuneration limits for working partners. So the limit was increased in the year AY 25-26. We are all aware threshold, which was more or less the same for about maybe 2 decades, has changed in the last year. It is increased from 1.5 lakhs to 3 lakhs, where the profits are on the first 6 lakhs up to where the books remuneration paid to all the partners in aggregate by the firm will not on the first 6 lakhs of the book profit, or in cases of losses, it should be higher of rupees 3 lakhs or 90% of the book profits. So bare minimum 3 lakhs is what you can give as remuneration today to any firm, whether it is under loss or having negligible profits as well. And in the balance profit, the same 60% continues in the earlier years, and even from April 25 onwards, the same will continue from April 26 onwards as well. There hasn't been much change in these provisions because there's already a recent change. The only provision is 40B5 is now known as 35E3. Drafting, the language and all of these sections also have been similar apart from minor 1 or 2 wording changes here and there, but predominantly it has been the same. I am repeating myself because whatever we've seen till now, there have hardly been any changes even in the grammar and the language, apart from changing it from negative sense to positive sense, which the approach is there in the new act. And book profits, they have also given tables which Zeel had mentioned earlier, that they've given a lot of tables and calculations on how to calculate these book profits. So they mentioned that the net profit as per chapter 4D, which is under the head PGBP, including your additions and subtractions under your computation under the head PGBP, and your remuneration, if any, deducted already in your P&L, you need to add it back, then calculate the limit of your remuneration under this section 35E3, which was famously known as 40B in the earlier years. And the next aspect is 35E4 talks about our interest on partnership firms, which was earlier under section 40B4. So interest paid earlier restricted up to 12% continues even now. Anything over and above that will be disallowed. Any kind of interest treatment where a person is acting as a partner on behalf of another person, there are provisos which were earlier given in explanations. Now it is forming part of the section itself, and it is telling that interest treatment where an individual is not a representative and his interest which has been paid will not be forming part of the calculation under section 35E, which talks about basically scenarios where we have partner in form of a representative SSE. He is paid the capital from his individual name, but he is as a representative, say example of an HUF or of a minor, and he's also put his own funds as well. It is not from the estate of the minor, and he's also put his own personal capital. Then that interest which is being paid to that partner who is there as a guardian is not going to get taxed or calculated under the head section 35E for the remuneration limits under the disallowances. And where the individual is a representative, basically when you're talking about Karta of an HUF is the representative of the HUF. The capital of the HUF, whatever interest is being paid, will get formed and forming part of the calculation under the section 35E. So that is also important. And in case if the person has been represented, example, this is more about looking at substance of a form. The law majorly looks into this aspect that in case a father has capital but he wants to bring in his second generation or any other person, or a husband wants to bring in his wife into the partnership firm, they give the money to the second person, which could be a spouse or it could be a son or it could be a grandson as well. In these aspects, if the money has been given by the grandfather, father or spouse, that will form part under section 35E over here. These aspects have not been looked into many times. Where is the money coming from? Whether it is from borrowed funds, directly coming in from the father or any other person. These aspects we need to look into little more rigorously and make sure that we are not missing out on these aspects, and this could create troubles in times of assessments and scrutinies. Also, interest treatment by individual on behalf of another or benefit of another, it will not be covered above as well. It is also covered under the second proviso where interest has been received by a person on behalf of another person. And section 35F, which is in line with section 40BA of the previous 1961 tax regime. Any payments made basically in terms of interest, salary, bonus, remuneration by whatever name called to the members of an AOP or a body of individuals will be disallowed entirely. The members, if they are paying any interest, and also basically there are instances where AOP has given money to a member and member has also given money to AOP, there is interest paid and given. In case if the interest given by the AOP is in excess of the interest received from the member, the excess amount which has been paid will be disallowed. So aspects of these cross-charging and crisscross entries also has to be looked into. Also, if there are any kind of representative members in line with our partnership firms, similarly if it is on behalf of someone or benefit of any other person, those benefits as a member of AOP would continue over here and restricted for disallowances under the head section 35F. There has been a lot of play under AOPs which has been happening not only under income tax but also under GST lately. So these aspects of what kind of expenses and what kind of entries are going in between the members and AOPs have to be looked into seriously. In terms of trust, it's already covered under exhaustive forms which we have, but there are a lot of non-audit AOPs as well. On those aspects as well, we need to be careful that any payments made in to members by an AOP should be disallowed under the tax calculations, and make sure that these are in line with the requirements of the law. Moving on to our disallowances of section 36, 35 covers mostly our expenses which were either in terms of TDS provisions or any kind of expenses pertaining to partnership firms or AOP. Now section 36 talks about expenses or payments not deductible in certain circumstances, which is in line with section 40A. famously known as the disallowance section for lots of aspects where lots of payments which have been done are covered over here and hitting our tax returns on a considerable way. So going to subsection 1, this basically talks about that this shall have a overriding and irrespective of any other contrary to the provisions contained. Sorry. Are we able to see now? So expenses or payments under section 40A, it is this section shall have effect irrespective of anything to contrary contained in any other provisions of the Act. Basically, it will have an overriding effect on any other provisions which says that it is an allowable expense or a deduction. If the conditions under this section have been fulfilled, then that will be disallowed. So basically, any kind of excessive or unreasonable payments made to specified persons. The Act goes to define what specified persons are also over here directly under the main head itself, and it is given a cross reference as well, so it becomes easy on what we are looking at. And this I will also look into that in a couple of minutes. The amounts paid to specified persons, which is over and above the fair market value, either there is a legitimate need in the business or profession, or there is a benefit which is accruing or arising to the assessee. This can be disallowed to the extent of excessive or unreasonable portion, and this decision is going to be taken by an assessing officer. This is not something which is defined. This is going to be a highly debatable one. Giving more powers to the assessing officer is where these sections are going to create a lot of difficulties in terms of related party transactions, in trying to be able to benchmark or be able to show arm's length transactions. This has existed before, and the power has now gone into the assessing officer's hands directly within the drafting of the statute as well. So this is going to play a broader framework on how and where are these payments going to be looked into by the assessing officers in the coming assessments. So specified persons, in case of an individual, very simple, relative of the assessee. Anything which we are talking about in terms of a relative, lenient assent and lenient dissent also is there. Companies, be it the director or relatives of the directors, firm, be it a partner or the relatives of the partners, AOPs, members of their relatives, Hindu undivided families, members of the undivided family and their relatives as well. So these are basically covering our specified persons over here, and this goes on in detail talking about, which is there in the old Act as well, continuing again in the same new regime as well under 2025. Under clause 2, we are talking about any person being an individual, company, firm, AOP or HUF having a substantial interest in the SSE's business, or their directors, partners or relatives or companies where first company has a substantial interest. So basically this is talking about any person who is having a substantial interest, which we are aware of, 20% interest in terms of a company, we are talking about voting power. In terms of a firm or a partnership firm or or a business, we are talking about 20% in profits. So these aspects, wherever there is a related party transactions between this, where you are getting this and a person who is having substantial interest also will get disallowed over here, and any kind of a company whose director, partner or member has a substantial interest. So either the company directly or their related parties in terms of director, partner, members or relatives are having interest in the other entity where the expense is being claimed, then this could be disallowed in the organization where the SSE's business and they are filing the returns and claiming expense in terms of payment done to these people who are having substantial interest in these entities. And also where a person is carrying on business where SSE has a substantial interest himself directly as well, those entities also, these will be disallowed. So these aspects, does anyone want me to explain again? In terms of wordings are a little confusing, but being using this on a day-to-day basis, and I have explained it as well. Anyone has any doubts till here? Moving on to the next aspect is Section 36, 6 and 7 talks about goods carriage expenses, and also talks about prescribed exceptions as well in the Act, where the provisions of Section 48.3 and 48.3a talks about payments greater than 10,000 rupees. Wherever payments have been made to a person in a single day, that will be 10,000 rupees. And in case of a goods transport agency, which was there in the old law, under a rule now has come forming part of Section 36, subsection 6. Please read 35.6 as 36.6 over here. Typo error, apologies for that. Moving on, expenditure will not be allowed on these if the payments are greater than 10,000 and 35,000 in cases of goods transport agencies. Prescribed exemptions are also being given in terms of where payments have been given in terms of the law is prescribing exemptions where there needs to be, or a situation which was there in the earlier Act as well, where the nature of or banking facilities are not readily available, where the business expediency does not allow them to use the banking channels easily. In those cases where it will be prescribed, which has not been prescribed yet, these subsections shall not be allowable and it shall not apply. Most likely and predominantly what was existing under the previous allowances, where there is a remote area, we don't have accessibility to banks or banking channels, or any kind of backward areas where we do not have accessibility to be able to reach out to banking transactions, or having network where you are able to do online banking. All of these scenarios will continue the same way which was there earlier as well. And any payments which have been done in terms of payments which were earlier done under Section 40A(3)(a) in the previous Act regime, same continues over here. Wherever these payments were allowed in the earlier year, expenses were allowed in the earlier year and payments have been done greater than rupees 10,000 in a single day to a person, it will be disallowed under the provisions of Section 36. Also, we are talking about legal protection and disallowances of expected losses. So there are situations where people are expecting losses and looking at as an expense. Although it might be booked in the books of accounts, that will not be allowed even in the earlier regime, continues to not be allowed even in the current regime as well. Losses cannot be allowed on provisional basis. If actual loss has been incurred in the year in which loss is incurred, that year is when you will be able to claim it as a loss. And you cannot provide a provision and reduce your tax liabilities, which was there in the earlier regime and continuing the same as well even now. Expenditure by way of any kind of mark-to-mark losses also, which is there in M2M, which we have usually in the year end in many cases. Those which were not allowed earlier will not be allowed this year, even now in the new regime under Section 35, subsection 9. And wherever the payments have been made apart from banking channels, although it is not being paid under account paid check or demand draft also, the same will be treated and deemed to be income under income tax, and that will be disallowed as an expense. The same existed in the earlier regime, continues to go in the current regime as well. Only thing is we need to just keep remembering and reminding ourselves of what is the new section. The old section is kind of stuck now, we need to unlearn that and kind of build these in for ourselves so that we are able to align ourselves when we are filing the tax returns in the coming year as well. This is going to be very important. Because right now our brains are wired in a way where we are able to just say 40A so and so clause, so and so clause. All of that we need to reset and restart. Going to our last section of disallowances and deductions which are not allowed and which is allowed on a payment basis. So basically Section 37, it talks about any sums which are being paid under subsection 2 shall be allowed at a deduction only in the year in which it has been paid, irrespective of any other provisions contrary to the Act, accounting method followed by the SSA, and the year of liability incurrence. All of that ignored. 43B comes here into play, and we are basically 43B is going to be 37 now. And the clauses under 43B we had around A to G, which has now come to A to G. More or less the same. One or two sections have gone maybe up and down. A few others are remaining the same. There hasn't been much change again. Running through them in detail one by one now. Clause A talks about any kind of taxes paid in terms of duty, cess or any other fee under any law enforced. Earlier we saw under section 35 was talking about income tax. Over here under section 37(2) talks about taxes paid under other tax regimes. So this will not be allowed for any taxes paid under this law. So any time where we have clients who have been following GST under composition scheme or GST under margin scheme, where they are paying taxes under their they're not collecting tax from the customer directly and they are paying taxes directly on the margin or the amount sold. In those aspects, if taxes are being hit, you need to pay attention to this and make sure that these are not allowed as an allowable expense. Under section 37 subsection 2 clause B, we have contributions which were done to any kind of provident fund, superannuation fund, gratuity fund or any other fund for the welfare of the employees were disallowed under section 40B clause B, will now be disallowed under 37(2) clause B. And any kind of payments made by an employer on account of leave encashment to the credit of the employee will be allowed on actual payment basis only, just providing for that expense will not be allowed under section clause C, which was earlier under section 43BF. Any kind of bonuses, any kind of commissions also payable will continue to get disallowed and allowed only in the year in which the payment has been done, provided we know under section clause A to clause H, before that comes F, if I am not wrong, G, clause A to clause G, we will not have a disallowance if the payment has been done before the date of filing of return, right? So it is A to F, correcting myself, and G is pertaining to MSME, which continues to be allowed in the year in which it is paid. Because if not paid under the provisions of section 15 of the MSMED Act of 2006, which we are all very well aware last year it had come in as an amendment, and from March 24 onwards we've been seeing that disallowance will be allowed only in the year in which there is actual payment done. But in other sub-clauses, if the payment has been made before the due date of filing of return, then that will be allowed in the year in which it has been done. So wherever we have made these payments of bonuses, commissions or any kind of interest on borrowings from flexible financial entities are also mentioned over here, are all covered under A to F, and these are allowed in the year in which or before filing of tax return if paid, it will be cleared. Specified financial entities over here have been clearly mentioned as public financial institutions, scheduled banks, cooperative banks, state financial corporations, notified NBFCs. These exclude primary agricultural credit societies specifically over here, and also there was D, A and E, which is now clubbed and merged into clause E directly. So that is the change which we see over here, and in the old section 43BF is now clause C. So we've seen a small correction in one section coming on top, another going down, and the interest paid on loans or borrowings will be allowed in the year in which it has been paid to these financial entities, and merely creating a provision will not be allowed, continues to be the same. And any amount payable to the Indian Railways for the use of railway assets, which was earlier disallowed under section 43BG, is now under clause F. The same provisions continue, and there is no changes in these under section 43B. We are also looking at deductions allowed on actual payment basis for clause G, which is earlier known under 43BH, which came into play from assessment year 24-25, and also minor change in the year 25-26 assessment year we saw. It continues to be disallowed in the year. If not paid within the year, it will be disallowed permanently, provided the provisions of section 15 of 15 days, 45 days as the credit period remains will all be satisfied. If it is not being paid within the provisions of section 15 of the MSMED Act, then this will be allowed in the year in which the payment has been made to the related MSME vendor. And section 37 subclause 3 talks about amounts specified under subsection B, except under the clause G, which I have already covered, if it has been paid on or before the date of return filing under the section 263(1), which is earlier 139(1). The new relevant section would be 263(1). Then deduction shall be allowed in the year in which the liability was incurred and not in the year in which the payment is made. Already touched upon that. Also under section 34, the 37 clause, subsection 4, if interest on a loan or advance has been converted into a loan, which we would have seen during COVID years, I don't think there are, or any kind of NPAs as well, we could see even in today's time. If a loan where that interest was payable has been converted into a loan and it has not been paid and converted into a liability, it would be deferred to the date to which this loan will be paid off. Just merely changing the nature of that loan to an interest or interest to a loan would not be allowed as an expense, and you need to take care that in terms of any kind of NPA where there has been any kind of restructuring or restructuring of a company also, or any other restructuring which is happening in terms of change or demerger, merger, also you have to take care of these aspects where these interests, if any, have been converted into capital or liability. It will be allowed in the year in which this loan has been repaid. This was earlier there as explanation 3C. It is now forming part of section 34, subsection 4. Further, under section 37, subsection 5, there is prevention on double tax deductions. So basically, if by any reason in any year someone has claimed that as an expense for whatever was disallowable in the earlier years, and you have by oversight claimed that, and now you are paying and claiming that again, that is not allowed. That was existing in the previous regime as well, as is specifically coming in under section 37, subsection 5. So this is basically to make sure that if anyone has erroneously taken any benefit of these deductions which were not supposed to be claimed, they cannot be claiming that again under section 34B, claiming that, 37, that we have claimed it in the year in which we are making payment. Double benefits is clearly disallowed. And also in terms of section 37, subsection 6, there have been provisions of where it excludes employee contributions. Basically, employee contributions do not really form part of our expenses, because these have been deducted from the employee's salary. We are talking about employee's contribution, not the employer's contribution. And the provision shall not apply if any sum received by an SSE from any employee as contribution towards any of these funds, being a provident fund, superannuation, gratuity, or a pension fund. These will continue to be allowed, and it shall not be applicable to employee deductions as an expense. So here you cannot claim it as an expense and charge it to your P&L. It should be directly going to your balance sheet. It is specifically mentioned that over here in your tax filing and return computation as well. So with this we come to an end to the disallowances which are there under the head. Broadly, section 40, section 40A, 43B have all been come under section 35, section 36, 37, and the predominant nature of these expenses, these nature of disallowances have been very, very identical. The entire concept is mostly just refining a few things where lots of things which are not needed have been done away with. Going on to repeating myself what Zeel also said and what I said earlier as well. So every time we'll keep seeing these provisions, we're going to keep seeing that, and we'll also find it a little difficult to be able to grasp on these new provisions, and the more and more we practice, I think we'll get a hang of this as well. And also this will create a little bit of room in terms of new litigations as well, because nothing which we always see as experience says never will we ever be litigation free or reducing in litigations, because human mind is gifted to be able to interpret things in the most unique ways, and SSEs and us also have been very gifted to be able to interpret it in very different ways. The same section we read today and the section we read tomorrow, we see many a times that we ourselves have been taking a different stance as well. So litigation will maybe reduce on lots of other aspects, and a lot of new aspects will keep coming in, and we'll make sure that we still have work for ourselves. Moving on to the next section, we have presumptive based taxations, which is under section 58 and section 61 predominantly. 58 is talking about section 44AD, section 44ADA, section 44AE, majorly covering our entire presumptive based taxation over here. We also have section 61, which is talking about 44B to section 44BBD. So we have lots of these which are getting covered under single sections rather than having multiple sections, and it is going to be more or less a revision one, so I am going to quickly run upon these because these are easy when it comes to understanding this from the provision point of view, but from practical implementation point of view, the presumptive based taxation, whether I am allowed under 44AD, 44ADA, a few of those discrepancies and confusions have been cleared over here because what are specified professions have been clarified, what do we have in terms of allowable presumptive sections have also been synchronized more easily rather than having to jump from one section to another which is not under sequence or whatever we have seen in the previous act. So a little bit of refinement is helping over here, and we'll make sure that we don't have to look at 44AD, ADA and 44AE, which talks about goods carriage agencies, and 44AD about businesses and 44AD about professions. The overview remains the same. Sections have come down to one section and subsections. It is applicable from 26 April 1st. We have totally 4 subsections. It has an overriding effect on section 26 to section 54, basically which was there in the previous regime. The relevant provisions of the current regime are 26 to 54. And wherever anyone is claiming or filing tax returns under presumptive based taxation, these sections would not be required to be adhered to. So basically whatever we discussed, in case if someone is following presumptive based taxation, the number of sections, the number of allowances, deductions, disallowances, restricted deductions, all of that is done away with. We all very well know that this has been a very effective tool for unorganized sector and also a few organized sectors as well, where the anomalies or the scale of work does not really warrant us to be able to look into it in detail. So that compliance has become easy, but moving into these presumptive based taxation seems easy, but moving out has always been a concern in the previous tax regime as well, and even now we are seeing that presumptive based taxation, if anyone is really opting for that, I would really advise you and also advise your peers and your clients or SSCs as well to please check whether they want to go ahead with these presumptive based taxations or not, because moving out of this is going to attract audit provisions, which is not going to be easy. People who are predominantly going to continue under this and not have any of these is okay. We have had and seen instances in the initial years as well. As a learning curve, I'm sure people who have done a lot of F&Os during COVID and after COVID years, we've seen a lot of intraday and F&O clients, presumptive based taxation, 1 year profit, the other year they are into losses and we have to do audit for 5 years. The mandate of 5 years is vague. No one has been able to understand that. I've been asking this question for many years. Why do we, if we opt out of presumptive based taxation under the presumptive regime, or we fall out of that regime, we cannot opt in for next 5 years under presumptive base again, and we have to get our books of accounts audited for 5 years continuously. This aspect I don't know how many of you have paid attention to, because this could create a lot of legal and notices, because I've seen many times where people have moved out of these provisions under presumptive based taxations and not done the audits for 5 years, which is a mandate under the present regime. What is the logic? Why is it not understandable? Ideally, in the year in which you move out, you get it audited, it makes sense. But there hasn't been any clarification on that. But from the drafting of the new provisions, it does not talk about this has to get audited for 5 years at least. So the redrafting is kind of what I understand from my interpretation, is that anomaly of 5 years mandate would go away for mandatory audit when you're moving out of 44 and your 58 section for individuals, HUFs and firms other than LLPs. So quickly running through this, we have resident individuals Already mentioned, HUF partnership and individuals other than LLPs. LLP do not have the benefit of section 4480 ADA or even section 58 in the new act. Where the business turnover is rupees 2 crores, you can file that with presumptive based taxation. 8% if you have a combination of cash and banking transaction. If you have banking and digital transactions, then 6% you can continue to file your tax returns. In case if you are a professional, 50 lakhs. And in case of a business who is having these transactions of cash receipts lesser than 5%, then the threshold of section 52 is increased to 3 crores, which is already existing under section 4480. Under section 4480A, that 50 lakh threshold increases to 75 lakhs if your total receipts or cash receipts of your total turnover is less than 5%. And in case of businesses, you have to declare 8% and 6%, 8% being your 8% of your total turnover or gross receipts, and 6% in case of those total gross turnover or receipts through digital modes. In terms of professionals, 50% continues. I'm sorry about that. I think there's a typo here. 50% of the total gross receipts over here remains. The second line does not come. And transport operators are basically operators who are flying with less than 10 vehicles at any time or point during the tax year, which is going to be used as a predominant term, tax year, we need to get used to. And any heavy vehicles, which was earlier in the 44AE, heavy vehicles over here is talking about any vehicle which has weight of 12,000 kgs. Basically that is considered and categorized under heavy vehicles. And on heavy vehicles, each ton of the gross vehicle weight on unladen weight and of each month or part thereof. So if you have X number of vehicles and it has so many heavy vehicles, whatever the weight of it is multiplied by 1,000 rupees per ton, you will have to pay as presumptive based taxation. And in terms of heavy vehicle, other than heavy vehicle goods which are lesser than 12,000 kgs vehicles which you have, there you pay flat 7,500 for each carriage for a part or entire month, whatever is there, as the tax under presumptive based taxation under section 58(2) for goods transport agencies. Very important aspect over here is many a times we have seen instances and we've seen many times lots of people debating that I have been given an option to declare at 6%, 8% for businesses, 50% for professionals. Why do I need to prepare books of accounts? Why do I have to calculate my profits? The underlying essence is that you need to calculate profits because if your actual profits are higher than 50% or 6 or 8% where required in the businesses and professional as 50%, you need to declare the higher income of it. So basically books of accounts shall predominantly should and always continue to be prepared over here. You cannot ignore the aspect that we are going under presumptive based taxation, flat 50%, 6% or 8%. You need to calculate these and see whether the actual profits are more or not. There have been a lot of ways and presentations which people have also been taking and pondering upon. It is, I'm just giving the food for thought that you have these sections under 26 to 54 done away with when you are under presumptive based taxation. So people have been putting their income tax expenses part of their income and expenditure and P&L as well. It is a debatable topic, ethically, not ethically, but these things have to be looked upon and clarified whether the provisions are not, it is not binding us to do that, so you can put in these tax expenses and claim that as an expense, or you want to go this way and you need to make sure that these expenses have not been allowed as well. In case if anyone is claiming any profits and saying that my actual profit is lesser than 6%, 8% in terms of businesses, 50% in terms of professionals, if you are telling that you have less than these requirements under the provisions of section 58, then the requirement is fairly simple as existed earlier. Maintain books of accounts as prepared under section 62, which talks about maintenance of books of accounts earlier under section 44AA, and you have to get your books of accounts audited under section 44AB earlier and now section 63. If you move out of this anytime, you basically cannot come into this for the next 5 years. I've already discussed that as well. So coming into the regime is easy. Following that as a presumptive based going concern and continuing is okay. In case if you have multiple businesses also, you can calculate that you are a professional and you are running a business as well. You can take benefits of both the subsections now, which was earlier 44AD and 44ADA, now under section 58.2 under the table serial number 1 and 3. So basically the Act which you read, it has tables again, and this section has the entire 44AD, ADA and 44AE sitting under a table. Serial number 1 is talking about business, serial number 2 is talking about goods operator, serial number 3 is talking about professionals. And anything which you are claiming lower is done. Restrictions on deductions, any loss again shall not be allowed against the income computed over here. Section 58 subsection 5 talks about deductions of salaries and interest to partners. So basically under table serial number 2, which talks about our goods transport agencies, if the agency is a firm, SSC is a firm, then the salary and interest paid to its partners shall be allowed as an expense. Apart from that, in case of a normal firm or a business firm or a professional, the interest and remuneration paid to partners shall not be allowed and it will be deemed to have been allowed. The provisions of WDV calculation will also be deemed to have been calculated. Basically depreciation, whether claimed or not claimed under your provisions of section 33 now, it will be deemed to have been claimed, and any kind of depreciation is done. 5 years continuity requirement is also done. I've already discussed this twice. And basically, if there is moving out of presumptive based taxation, mandatory books of accounts have to be maintained. So anyone who is under presumptive based taxation, not maintaining books of accounts, not having a proper income expenditure, P&L or balance sheet, will be a draconian task for anyone to be able to get it back into audit, and whoever is auditing those books of accounts in those years is always had and will continue to have a hell of a time. So it's always better to make sure that good practices have been followed. Whatever is the tax regime, your books of accounts have been maintained properly, and think before you opt for these presumptive based businesses in many cases, because the person has been doing good. In the last 5 years to 1 decade, I think nearly a decade, we've seen instances where people have done beautifully well in businesses for 2 years or X number of years, and then X number of years they've done terribly bad also. So these kind of situations can really create practical hurdles and difficulties for us. The provisions are more or less similar and nothing new over here as such, but the only thing is we need to keep refreshing ourselves and make sure with this opportunity we make sure that what the law is, we refresh ourselves, restart and reset. Reset and restart. So specified professions over here have also been mentioned under section 2, subsection 49 and clause R, which talks about legal, medical, engineering, architecture, accountancy, interior decorators, technical consultants, authorized representatives, film artists, company secretary has also been mentioned specifically, and IT professionals, which is similar to what was there in the earlier regime as well. This is sitting somewhere under schedules and this one. Now it is coming and forming part of the entire statute under subsection 10 of section 58. And I've also discussed this already. 5811 talks about treatment of multiple business categories. So if a person has business income and has a professional income as well, and he's following presumptive based taxation, can take benefit provided separate books of accounts or separate bifurcation has been done for the business and the profession, and you can claim that as well. And also in case of a goods transport agency having multiple businesses as well, you can continue to do that separately as well and claim that as expenses in your, claim the benefits of the presumptive based taxation under your tax return. Section 61 talks about your presumptive based taxations, which are predominantly talking about activities or business activities in cases of non-residents, these have famously been existing for X number of years under section 44B, and coming to that we have 6 sections up to section 44BBD. So these special provisions which have been sitting under 6 sections have now come under a single section 61. The basic crux of this is section 61 has around 8 subsections, where the first section predominantly under the new act we see it will have an overriding effect, not contrary to anything. All of these mentioned directly under subsection 1 rather than what we've seen in the earlier act. It is forming part of the section and not as a subsection. Now these are coming specifically under subsections. Also there is a computation table about 6 business categories which talks about whatever 6 business categories, we'll be discussing them in detail. The aspects of this is restrictions are similar to what we have under residents as well. Lower income option, you need to get your books of accounts maintained and get your audits done under section 63, which is the tax audit under the new act. Also there are restrictions on losses or deductions, which there are no losses or deductions allowed, which was there again in the previous section 58 as well. WDV to be computed over here under subsection 5. Subsection 6 talks about non-applicability of the sections which are basically from section 26 to 58, 54. And also definition of plant has been given over here, because whether it is a vessel, aircraft or kind of this thing which was earlier mentioned in the old act as well is mentioned over here as subsection 7, and resident companies, what conditions they have and what they follow has been forming part of subsection 8. Coming to the 6 aspects of the non-resident business cases over here, we are talking about serial number 1, which has 6 ships excluding cruise ships. Operations of these ships which have been operated by a non-resident, there is a component of deemed income can be paid at 7.5% of component A plus component B. Component A is talking about carriage receipts from Indian ports paid or payable anywhere. So wherever these receipts are pertaining to Indian ports, whether paid in India or outside India, will be forming part of this thing as long as it is receipts pertaining to the Indian port. And from foreign ports as well, where they are received or deemed to be received in India, depending on the deeming provisions. Sum of both of that will, and 7.5% of that has to be paid as taxes under presumptive based taxation. These includes people, livestock, mails, goods, etc. Everything. It is not restricted to goods alone. And it also talks about additional charges over here and similar charges of handling, and all of that also will be separately claimed. Serial number 2 talks about cruise ships. Cruise ships are basically anyone who is operating a cruise ship, which was a new introduction just a year back, if I remember right. And any non-resident can pay taxes at flat 20% of the passenger carriage fees, or the passenger carriage fees payable in India or deemed to be paid or received in India. So similar to what we've seen under ships, the same thing continues over here, 7.5 over there, 20% over here. And under aircraft operations of aircraft, it is 5% of your component A and B remaining the same, and the components included over here is also the same in terms of what kind of goods we are dealing with. Turnkey power projects has also been an important aspect which we've been seeing gaining momentum in the past few years. Lots of foreign entities have been coming into India and doing a lot of turnkey power projects and development projects, and lot of civil construction relating to these power projects which we have. So if a foreign company has taken over that and it has been approved by the central government, 10% of the total consideration can be paid as the tax, and it can be the entity can be considered themselves to have relieved themselves of the tax liability. In case anyone wants to claim lesser than 7.5%, 20%, 10% or 10% over here as well under minimum oil services, audit which was there earlier continues to apply under section 63. Electronics manufacturing services have also been a new aspect which was come in recently. This talks about a non-resident company providing electronic manufacturing services to a resident company. So whatever amounts they've been paid for services or technology or amount deemed to be received or paid for the services or technology, 25% of that has to be paid. So this is where you have electronic facilities or manufacturing electronic facilities promoting the Make in India project. The government has gotten this into play. We've already discussed that claiming lower income wherever we have, getting books of accounts maintained, audited, furnishing the audit report within the time prescribed 1 month before the return filing due date under section 263 subsection 1. And we also have already discussed that no deductions, written down values which were there under residents are also similar over here. In case where section 61 specifically says that it shall not apply to special provisions in cases of insurance businesses, royalty businesses, in hands of non-residents, tax on certain distributed income which we already have being received by a foreign entity, and tonnage tax systems. These are all not eligible for claiming deductions or presumptive based taxations under section 61. Also under section 58, we continue to have that commission agency business or agency companies cannot opt for presumptive based taxation, which was there under section 44 AD, continues to remain over here under the new act. Section 63 is the last segment of our session, which is basically talking about tax audits. There hasn't been any change from the previous year tax audit provisions to this year. Only thing which has changed right now is section 44 AB has become section 63. That is predominantly there. The section 44 AB had become pretty bulky. Right now section 63 looks very short and sweet, and it gets done in about a page, not much. So there is a table which covers businesses having turnover of 1 crore rupees. In case if the gross receipts or payments are lesser than 5%, then the threshold increases to 10 crores. In terms of profession, it is 50 lakhs, and where this is increased lesser, then it will go to 75 lakhs. You can go under presumptive based taxation. This does not increase the threshold over here. So just trying to revise and maybe refresh and recap. Section 44 AB talks about you can go under presumptive based taxation up to 2 crores. 3 crores if your digital payments are lesser than, cash payments are lesser than 5% and digital payments are 95%. So audit is still 1 crore. So if you are filing your tax returns normally and you have a cash business, you either have to opt for 4480 mandatorily to avoid income tax audit, or you have to get your books of accounts audited. There has been and is still many a times confusion on this. We need to always remember section 44AD, 44AB runs parallelly on many aspects, and lots of that has always created a lot of confusion and lot of anomalies, and we need to keep refreshing and reminding ourselves that these provisions, if you are going and opting for this, the day you move out of it, either you can avoid audit for a couple of years if it is having cash transactions greater than 5% and your turnover is more than 1 crore, or you are able to push it under the presumptive based taxation where your 5% thresholds and your thresholds of receipts and payments have not been looked into and can be ignored. So that has to be a strategic call which you need to take and advise your clients. Also, I think this more or less clears all of it. Wherever presumptive based taxation people are declaring lesser deemed profits or lesser profits than the deemed profits, then you need to get your books of accounts audited, be it a business or a profession. Section 63(2) shall not apply to, basically the audit section specifically mentions that even if your turnover is greater than 1 crore, under section 58 and 61 you are not required to get your books of accounts audited because you are under presumptive based taxation and you fulfill those sections. This specifically gives us the exemption, and I think this covers most of whatever we have. In case if you have any doubts or any questions or clarifications, I will be happy to answer them. Thank you.
Regarding this partnership deeds,
Yes, sir.
earlier we were mentioning remuneration as per section so and so is available.
Yes, sir.
Now the sections have been changed.
Sections are same, sir. Only numbering has changed.
No. Earlier it was 40. Now it has come to 35.
Yes, sir.
So still whether we have to change the partnership deeds?
Sir, sections you have, so it depends on the drafting of the partnership deed.
Yeah,
If
we
the
have
deed has been drafted.
We have mentioned section 40, as per that remuneration is available as under.
Great, sir. But
Now
after that,
the
I put a sentence which talks about or any amendment or act time being in force, any terminology like that has been given.
Okay. If it
That
is
is the
silent,
drafting which plays over there, sir.
okay, if it is silent, what we have to do?
Sir, if it is silent, you want to do a good practice, make sure that you get your partnership deeds updated. A very good opportunity for you and your clients to make sure that you are recalling whatever has been done X number of years ago. It is becoming very, very mandatory and very, very advisable to review all of these every few years. I advise my clients to make sure that the partnership deed has been reviewed every 2 to 5 years at least now. Looking at the way businesses have been moving, you need to review and make sure that the necessary updations have been done. So it was required earlier as well. Just because the terminology has been changed, it will not practically create any difficulty for you because it will be understood and implied in most cases. But where you actually have and need to change those provisions to come in line with the new act, to come in line with the provisions of TDS, where there is a lot of ambiguity in terms of your TDS provisions in the month of March, whether you will be able to put your remuneration under 40B, under the thresholds of 90% up to 6 lakhs and then 60% of the balance profit. You will be able to assess that when? August month, September month, and then pay TDS on that. Those all I think all of us have more or less covered today, and we need to make sure that before 31st of March, we either have the coming year's partnership deed updated and rectified so that there is no complication when it comes to from income tax point of view and other laws as well, because today no matter where we go, updated partnership deed and in terms of your books of accounts being in agreement has to be very, very important. This aspect I have seen had been ignored a couple of years back, but definitely cannot be ignored anymore, especially in the last 3 years. I think the amount of revisions I have done in partnership deeds, I have not seen in the last 1 decade of what I have done as well. So the changes in law is mandating and requiring us to make sure that we get this updated, and definitely more work the merrier for us. Because if we don't do this, then the client is going to come back to us saying that we have not done this right. Yes.
Please correct me. For 44 ADA,
Yes. I'm sorry, I'm not able to hear you. One moment. Can you have a mic?
So for 44 ADA, profit and gains from the profession, where we have not followed 50%, then we have to do the tax rate for the next 5 years.
Yes.
Please correct me. I think for 44 ADA, I think the existing law, I read somewhere that there is an exception that is given that you will not do the tax audit for the next 5 years.
Yes, 44 ADA is not applicable.
It's not
That is there for 44 ADA. Very true.
Yeah, 44 ADA. Right?
For 44 ADA, you are not required to get the 5 years, but 44 AD you are required to get it under 5
So
years.
even in the new law,
New law, the same would continue, but the drafting which is there, I have seen that it is not mentioning that it has to be audited for 5 years continuously anywhere.
for all the sections,
No, 44 AD, which I am referring to section 58, subsection 2, table 1, serial number 1.
okay,
Table serial number 1. That is talking about your 44 AD in short.
okay.
So it's just that your sections have come into a table now. So that will go into this. Also, 44 ADA has one interesting anomaly. I will take 2 minutes to discuss this actually. Because 44 ADA, the drafting is such that if a person is declaring income, if a person having professional income is declaring profits, net profits lesser than 50%, the drafting of the law is such that the professional shall have the books of accounts audited. Whether or not I was under 44 ADA is irrelevant based on the literal reading of the Act. And if we read that as a precautionary measure, have advised and been advising clients to get their books of accounts audited under 44 ADA, although the threshold has not increased 50 lakhs or 75 lakhs as the case may be, and you are declaring lesser than 40% of your profits. The biggest challenge over here is the drafting is such that it can create trouble. But there have been lots of stances and lots of scenarios where people have taken a stance that I am not required to get my books of accounts audited as a professional under section 44 ADA. Now that will more or less get done away with over here, because that drafting under 4480 was very different over here, and this is in line with our 4480, which is now under section 58. So the scenario which was there will maybe see sunset up to March 25. And in the coming years, I will also have to, law is also fairly new, also read very detailed as well. We'll have to see that this confusion under 4480, a mandate of audit will go away. This is not relating to the new act, but a practical issue we've been facing for many number of years now. This will come in 2021 if I remember right. Anyone else?
Sir,
Yes, sir.
predominantly if it is the same, why they are doing this exercise?
Sir, basically, if you have an old building and new building, which one do you prefer?
But provisions are the same.
Sir, provisions are the same, but there are lots of redundant and unwanted information. There was a lot of things, and also we can say that it is kind of something which 60 years the law has existed one way. Yes, it kind of needs a review and needs to be refreshed and reset. Change is part of our process and inevitable. If we don't change and update ourselves, we very well know where we were standing 10 years back and where we'll be standing 2 years later also, we don't know where it will be.
But there is no much change.
So there's no difference in terms of the law as such. It's only that it is, like I said a couple of times today, that it is an opportunity for us to make sure that we are resetting ourselves and revising our fundamentals right, sir. We've been doing lots of these for decades now, and lots of things we have ignored, or by oversight we missed out. This is an opportunity for us to refresh our fundamentals and make sure that we are going right ahead as well. That's where I was, while talking today, most of the time I was talking about what difficulties we are seeing, where we are seeing, what we are seeing, and where we need to make sure that we are going right as well, because that is the main aspect. Change government will do for XYZ reasons, hundreds of reasons, hundred of people will give theories. But what we can do best out of it is what I'm looking at it is as an opportunity for us to make sure that we increase our expertise and make our fundamentals much more stronger, and increase our base as well on the fundamentals of our provisions of this Act. Thank you, sir. Thank you.
Thank you, Siddharth. Your insights on the disclosure and audit provisions under the new Income Tax Act 2025 was remarkable, and hope members have benefited from it. And we thank you for sparing your valuable time. May I request Chairman Manjunath to present the memento to the Speaker as a mark of respect and gratitude. Thank you all. Have a good night.